Right, everyone, Marco Palmero, founder of Ulysses in Dubai, and welcome to another episode of Acquisition Case Studies, where we take deals that we have sourced and negotiated in the past, we break them down, we analyze them, we find mistakes and lessons that we can take away from them so that we can ultimately do and execute better deals in the United Arab Emirates and in the Middle East. Of course, most of these deals are part of our own proprietary deal flow at Ulysses. Some of them will be deals that we negotiated on behalf of our clients, but all transactions will be kept strictly confidential, so no relevant information will be shared here. In terms of the way these videos are structured, we want to help all the business executives, entrepreneurs, investors looking to buy companies in the United Arab Emirates and in the Middle East. Hopefully, these lessons can support you, provide you some information, and avoid you wasting money, resources, and time on the wrong transaction. This deal was one of the ones that I liked the most. I really wanted to get this done, but I personally made a terrible mistake, which I'm going to discuss with you shortly. But before I actually do that, let me give you the background of the deal, a little bit of an overview. We're talking about a service-based company here, operating for about 8 years in the country. We were talking about UAE, and in terms of staff, around 20 people were working at a facility. 9 of them were the key service providers, so the guys seeing clients, the others were support. There was no real estate involved in this deal, and fundamentally, the reason why the ownership wanted to exit the business was because of retirement. So it was a perfect news for us. It was a very good news. It was exactly one of the motivations that we look for when talking with small business owners. Be reminded that in this particular transaction, we were talking about 2 owners. So there were 2 partners in this deal that both wanted to exit. So they wanted to relocate back to their home country. They wanted to set up a shop over there, spend most of their time close to their family, and avoid constantly being traveling between their home country and the UAE, which was substantially what they were doing. They were spending 5 days in Dubai, then flying back, and then flying in for Monday. So that was the motivator, and we felt it was a pretty compelling reason, especially because they were getting old. Now, in terms of revenue, the business was performing well. $2.7 million in revenue a year and about $800,000 in net. Strong cash flow and a pretty good financial picture overall. The owners were taking out huge dividends, so it was a solid enterprise. Now, we started negotiating the deal, and we had the conversation with these owners around the process and how everything would look like. We initially offered them a structure for the deal, which they negotiated but ultimately accepted with a few variations. And so everything appeared to be going in the right direction. Now, true to be said, they also shared all the information in full transparency. Everything was clean and pristine. The reporting aspect was 100% spot on. So even from a due diligence standpoint, there was very little that we could find that could make us feel there was something wrong with the deal. And that was a very good news, right? Of course, there was still a little bit of skepticism from our side because there's no deal that is perfect, right? But everything looked very, very good from a financial and legal perspective. Now, let's get down to the mistake that I've made. And it was my personal mistake, not my team, not anybody else's, not even a problem with the seller. It was my personal mistake. There were 2 owners in this business, and I had one discussion with the 2 of them, and at that time one of them said, okay, I'm just gonna relinquish all the decisions to the other guy. You can talk to him because he's the one who's more involved in the business aspect of the deal. I'm more focused on seeing clients. So you can talk to him. He will be your point of reference. The mistake I made is that I accepted that condition, and I started from that moment on dealing only with one person of the two owners. Now, why was that a mistake in hindsight? Well, of course, because I always dealt only with 50% of the owners, and I never really built the relationship or knew what the other guy was thinking about. Now, I didn't realize that until we were getting close to the end of the deal, right? To structuring the purchase and sales agreement and all these sorts of things. Because at that point, some friction started to come out. And it appeared to be quite unusual because I had built a very strong relationship with the person I was talking to, and he was very committed in the deal. So I couldn't really figure why all of a sudden he started to change opinions and back out a little bit, right? There might have been some seller remorse, but it didn't appear to be the case, right? My intuition told me that wasn't the case. What I ultimately realized was that the other guy had changed his mind throughout the process, and he was now trying to do everything he could to prevent the deal from happening. And so what ultimately ended up happening was that I realized this, the other guy kind of let me understand that was the problem. We sit down with the both of them, and in that meeting, the other guy completely exploded, right? And he brought to the table a lot of objections that I didn't address because I simply didn't talk to him at all. I mean, I talked to him one time in the beginning, and then I didn't see him for the entire duration of due diligence. And so what happened was that basically the other guy was pretty okay with the terms and conditions, but the moment he was reporting these terms and conditions to the other owner, the guy was becoming a bit resentful, and he didn't came out mentioning that was a problem for him and that was a problem for him until we got to the finish line, and all these things that had piled up exploded. And of course, once that happened, there was very little that we can do to save the deal because all this emotion had piled up. The guy came to the table in a very aggressive manner, and he demanded changes that we couldn't really make because they were just bonkers, right? Crazy. He asked for huge salaries for transition, a huge price increase, and all other things that I'm not going to mention here. But the point was, as I was sitting in that meeting, I realized, damn, you made such a rookie mistake here, because you should have involved both of them in all discussions. Even if it was more difficult for you to get both of them in the same room for multiple meetings, it was still something that you needed to do. It was your own responsibility to make sure that these two guys were constantly aligned and sold on the transaction throughout the entire process. And I didn't do that. That was a terrible mistake from my side, because again, I always relied on 50% owners, and I was trusting him with his decisions, thinking that 100% of the owners were thinking that way. Well, I didn't really process the fact that the other guy might be changing his mind, throughout the exercise. And that's exactly what happened. And so I think, a couple of lessons I took away from them. First, the mistakes that I've made. So it is important to keep all the owners involved in the process at all times, even if it is more painful and if it takes you more meetings to get aligned. It is still a priority to have both of them informed and have both of them in the same room at all times, so that there's no, misjudgment or misunderstanding, or the example that somebody says, I'm gonna ask my partner and then get back to you. You want to avoid all that, and I needed to avoid all that. And then another aspect is dealing with multiple owners is a pain in the ass, right? Because you got, of course, multiple opinions, multiple heads that are thinking in a different way. And so some things might sit well with one person, but they might not sit well with the other. And so it's much more difficult to align both sides, both owners in a transaction. And that's why I also stress the concept of not having a lot of people involved, like brokers and stuff like that, because that creates other people that are involved in the process that need to be sold on the deal before everything moves forward. And so the second lesson I took away was, if you find deals that are 100% owned by one person, that's much better, because of course you're dealing one-on-one. You don't have all these headaches. You don't have these ping pongs that are happening all the time. And it is much smoother as a process. But still, I'm not shying away from the mistake I've made. The deal was good. It appeared to be good from a financial perspective, and everything checked out from a due diligence perspective. So it was just my responsibility from a strategic perspective to keep the two guys involved in a deal. And again, it was a lesson well learned. Thankfully, I didn't make that mistake anymore. But the first time it hurt, and it hurt badly, because the deal was also quite a good one, to be frank, although it wasn't a big one. So those are the takeaways from this deal. A bit of a personal lesson here. Hopefully you find it helpful, and I'll see you in the next episode.